Welcome back, guys. Let's move to our step number 3, that is determining the transaction price. It is nothing but identifying the contract price and how much revenue we will recognize at initial recognition, and basis that we will split our revenue to the different performance obligations which we have identified above in step number 2. So what is the sorry so what is the transaction price? So transaction price, it is nothing but a expected consideration in exchange of goods or a service. It can be a cash consideration which is given straight away in SOW. It can be a cash plus non-cash consideration. It can be fixed or variable, or it can be fixed plus variable. So we need to read the contract very carefully to understand the what are the fixed consideration and what are the variable considerations. Now variable consideration, the name suggests it is variable, it is an estimated basis. So IFRS 15 says variable consideration should be estimated at such price that significant revenue reversal does not occur in future. So we cannot do the estimation on a higher side and then derecognition of revenue happens at a lower stage. So let's take an example. I am a chartered accountant. A customer came and said, you have to do my accounting services. Your fees are $10,000 fixed, which we will pay you in 12 equal installment plus 5% of our closing price of our share on the reporting date. Now here your consideration is fixed $10,000 plus variable 5% of the share price. Now we don't know what will be the share price of the company. Let's say today it's $100. It can be $10. It can be $1,000. We need to estimate that how much consideration it is probable that we will recover. There can be a slight true up or true down, but significant revenue reversal should not happen. So let's say you have estimated the $1,000 will be the share price and you have recognized the higher revenue. At the year end price was only $120. So there is a big difference of $800 which you need to reverse. So you should not estimate in that way that significant revenue is reversed. Now when we are talking about variable consideration, there are few points that needs to be discussed. Number 1, consideration payable back to the customer. Number 2, volume discounts. Number 3, significant financing component. Number 4, non-cash consideration. And here point number 4, there is a difference between IFRS 15 and US GAAP 606. So we will understand what is the difference. So let's talk about the variable consideration, its constraint in estimating the variable consideration. So first point, consideration payable back to the customer. IFRS 15 says if anything you are paying back to a customer, it should be recorded as a reduction of your revenue unless we are receiving some identifiable services at a fair price. For example, I am providing $10,000 accounting services, but I am paying back $2,000 to a customer for some IT help. Now I need to see first of all whether this IT help is a separate service. Yes. Is $2,000 a fair value? If yes, then this $2,000 will be reported as a cost and $10,000 will be revenue. Let's make it a bit more complex. Fair value is only $1,000, but I am paying client more just to retain my accounting services. In this situation, IFRS says that if consideration payable to a customer is higher than the fair market value of services received, then excess consideration will be recorded as reduction of revenue. In our case, $10,000 is a revenue from sales, accounting services, less $1,000 excess fair value paid towards the IT services, and remaining $1,000 will be reported in cost. Now this is a very easy example, easy to estimate. A lot of contracts in big firms comes like this, that if sales is up to 1 lakh unit, we are not paying back anything to a customer. Sales up to 1 lakh to 2 lakh unit, we will pay you 1% of our revenue back. If it is more than 2 lakh, we will pay you 2% of our revenue back. So here now you need to estimate that how much consideration you will pay back customer at the end of the year. You cannot say that first 11 months we will not provide anything and then finally on 12 months we will provide everything. Or maybe let's say you will say we have to pay anyway after 1.5 year. Next year accounting period we will take the impact because our matching principle will get impacted. So here we have to do the revenue provision. So how we can do, again this is a judgment based thing, not a rule based thing, so your technique may be different. What I can propose that let's say your monthly sale is $50,000. So at the end of month 1 you are expecting 6 lakh annual sale, you are falling more than 2 lakh revenue category, you have to provide 2% discount divided by 12 as a current month revenue provision. Let's say in the second month you just did a sale of $10,000. So now your cumulative sales is $60,000. Make it annualized, make the provision. So and so on, by end of 12 month you can have the right estimate and you may not have quarterly reporting impact because IFRS is applicable to big firms. It will have the quarterly or half yearly reporting. So you have to ensure that your quarterly results are also accurate. So you should not do the provisioning only at the end of the year, but you have to do on monthly or a quarterly basis by annualizing your revenue or estimating your revenue. So again, let's quickly summarize consideration payable back to a customer. Two aspects. Number one, if we are receiving any services, no reduction of revenue. If we are receiving services, yes. Is it at fair value? Yes, report at a cost. Are we paying more than a fair value? Excess amount is a reduction of revenue. Balancing figure reported as a cost. That's the first point, consideration payable to a customer. Second, significant financing component. Now, what happens at time that you are delivering some services in January 2021, but contractually you can bill them in December 2022. That means the day when service is provided and the day when collection is due is having a vast periodic difference of more than 12 months. In IFRS 15 has clearly given a guidance that anything less than 12 months basis materiality you can ignore that. So in our case it is a more than 12 months. In that situation you are not only providing the services but you are also providing the implicit financing services to the customer. Let's say your revenue due is $10,000, your relevant rate of interest is 10%. In that situation it is assumed that you are earning $9,000 out of your sales accounting services and $1,000 out of the financing component, and you need to record it as an interest income rather than revenue from operation. Now this financing services financing component you need to do the fair value at the inception of the contract and not at the later stage. Let's flip the table. Customer has paid you in January 2021. You are paying them in 2022. Is there any financing component? No. So IFRS 15 has clearly stated if you are receiving the money in advance, then you are not supposed to do any financing component adjustment. It is only in the situation where you have already provided the services and the collection date is at the later stage. Okay, so we have done 2 points: consideration payable back to the customer as a variable consideration and significant financing component. Now let's understand certain constraint in estimating the variable consideration. Now there can be a n number of things. Volume discount, we saw one example. There can be a SLA penalty. For example, accounting services, I have promised client that by end of 5th of every month I will show you the report, financial statements. If I am late by one day, I will pay you $100 penalty. Now this is again a variable consideration that my contract value can go down if I have failed even once in the entire 12 month. Let's say then my contract value is $9,900 because $100 I have to pay back to the customer. So again, SLA penalties are the part of the variable consideration we need to estimate. So what will happen in a big corporate? You need to be in touch with your project managers or delivery managers to assess how the project is running as per the schedule. Are we expecting any delays? And if there are any delays, what are the contractual penalties that we may be required to pay back to the customer? So again, SLA penalty, volume discount, these are in the variable nature. The constraint variables, as the word suggests, it is difficult to estimate. Nobody has seen the future that how it will turn up. But basis your past practice and the best information available at that point of time, you need to document that and you need to assess in best possible manner such that a revenue reversal at a significant amount should not happen in the future. And the last aspect of determining the transaction price is non-cash consideration. Sometimes customer will say your fees are $10,000 plus going to give you a 10 share of my company at this date, or maybe some asset, maybe gold, maybe anything else. In this situation, you need to assess the value of non-cash item as your consideration. It may be a surrender value, it may be a book value, it may be a replacement cost. Basis the best available information, you need to account the non-cash consideration. Now here sometimes barter transactions do happen. Specifically, let's say I am a tax consultant and I want a lawyer services. I'll say that okay, look, Mr. Lawyer, I'll give you accounting services for 1 year. You fight some legal suit for me, and this is a barter. I'm not going to pay you. You are not going to pay me. In this situation, now there is a difference between IFRS and US GAAP. IFRS says you need to estimate the services which you are surrendering or which you are receiving, whichever is clearly identifiable, and you need to assess a transaction price and record the revenue accordingly. There can be a difference that accounting service is only $10,000 or lawyer service is $20,000. So are we recording any notional loss? No. We will restrict whichever is lower, that is $10,000 as our transaction price. What US GAAP